Hi everyone, before we get started, I just want to say this clearly and honestly. This video is for educational and informational purposes only. I'm not here to tell you what to buy or sell. I'm here to share perspective. The kind of perspective you only get after watching markets move for years. Now let me ask you something. Have you ever noticed how investing advice online often sounds like this? Buy this ETF, sell that stock. This one pays 12% yield. But nobody really talks about how things work together. And that's what this video is really about. You know, the other day I was thinking about wine pairings. Stay with me here. Most people know this intuitively, even if they're not wine experts. You don't just grab any wine and any food and hope for the best. A bold Cabernet with a steak, a lighter white wine with fish. The right pairing doesn't overpower. It enhances. It balances. It makes the whole experience smoother, more enjoyable. And at some point, I realized investing works the same way, especially when we talk about ETFs. I've spent years working with American investors, retirees, professionals, business owners. And one mistake I see over and over again isn't that people choose bad investments. It's that they choose good investments that don't belong together. They chase yield. They chase growth. They chase whatever worked last year. But they rarely stop and ask, does this actually balance my portfolio? Or does it just add more noise? That's where the idea of ETF pairing comes in. Think of pairing as intentional investing, not random diversification, not owning 20 ETFs just to feel safe, but deliberately combining strategies that offset each other. Let me give you an example. A lot of people I talk to have a core US market ETF, something tied to the S&P 500 or the NASDAQ. That makes sense. The American market has been a growth engine for decades. But then they add another ETF and another, and suddenly their entire portfolio is just tech exposure wearing different clothes. Have you ever looked at your portfolio and thought, wait, why does everything move down at the same time? That's not diversification. That's correlation. One of my friends, he's in his early 60s, once told me, I don't mind volatility. What I mind is surprises. And that stuck with me because the goal isn't to eliminate risk. The goal is to understand it and manage it. That's why pairing matters. When you combine a broad market ETF with something more aggressive, like a leveraged or high-yield strategy, you're not just chasing returns. You're shaping behavior. You're deciding where growth comes from and where stability comes from. And here's something I want you to really understand. High yield by itself isn't dangerous. Growth by itself isn't dangerous. What's dangerous is concentration without awareness. I've seen investors panic not because their portfolio dropped, but because they didn't understand why it dropped. Everything was moving in the same direction. There was no counterweight, no anchor. When you pair a high-octane growth strategy with something more boring, more value-oriented, more dividend-focused, you're not giving up upside. You're buying emotional discipline, and that matters more than people realize. Behavioral finance tells us this clearly. Investors don't lose money because markets go down. They lose money because they exit at the wrong time. Fear destroys more portfolios than volatility ever will. That's why boring assets exist. Blue chip dividend stocks, value ETFs, lower volatility income strategies. They're not there to excite you, they're there to keep you invested. And when you pair those with more aggressive ETFs, something interesting happens. The portfolio becomes more resilient. You stop reacting to every headline. You start thinking in systems, not trades. This is how institutional investors think. They don't ask, what's the best ETF right now? They ask, how does this behave in different market environments? Sideways markets, rising markets, falling markets. Covered call strategies, for example, tend to shine when markets chop around. Leverage strategies capture momentum when trends are strong. Value-based income ETFs soften drawdowns. Split share funds introduce a different risk-return profile entirely. When you pair these intentionally, you're no longer betting on one outcome. You're designing a portfolio that can adapt. And that's the real lesson I want to share with you today. This video isn't about chasing performance. It's about building something you can live with, something you can hold through uncertainty, something that doesn't keep you up at night. Because at the end of the day, The best portfolio isn't the one with the highest return on paper. It's the one you can stick with when the market tests your patience. So in this video, I want to walk you through a few ETF pairings that actually make sense. Pairings that balance growth and income, risk and stability, emotion and logic, not theory, not hype, just practical portfolio thinking. Explain the way I wish someone had explained it to me years ago. If that sounds useful to you, stick around.